Welcome to the Deep Dive. We're your compass, helping you navigate today's, complex financial world.
Hmm.
Today, we're really digging into Morgan Stanley's second quarter 2025 earnings. We're not just scratching the surface here.
Definitely not.
We've gone through the official results, analyst takes from places like TipRanks and Investopedia, even the full conference call transcript.
Yeah, the whole thing.
Our goal is really to give you that shortcut, that deeper understanding, get you ahead of the curve. And you might actually be surprised by the market's reaction. They crushed expectations, but, we'll get into that.
That's right. And I'll be synthesizing all these different views, helping you understand not just the what, but the why. Why does this matter? What does it tell us about, the bigger picture Morgan Stanley's operating in?
Okay, let's unpack these headline numbers then. Morgan Stanley really put up some undeniably impressive figures for Q2. Net revenues were $16.8 billion.
Yeah, that's up from $15 billion just a year ago.
Yeah.
Pretty significant jump.
And earnings per share, diluted, came in at $2.13. That handily beat the street's expectation of $1.98.
Right, a 17% increase year over year from $1.82. Pretty solid.
Yeah.
But what's really insightful here, I think, is that this isn't just one good quarter. It's their sixth consecutive quarter of consistent earnings. And that's across, very different market conditions.
Sixth.
Yeah. Ted Pick, the CEO, he highlighted this specifically, said it reflects higher levels of performance. And that's not just jargon, I don't think. It suggests they've built a really adaptable business model.
How so? Adaptable.
Well, maybe through that diversification across their segments, right? It lets them generate value consistently, even when maybe one area faces headwinds. It points to a kind of strategic resilience.
That makes sense. And their return on tangible common equity, the ROTCE, hit 18.2% this quarter.
And 20.6% for the first half. That's impressive.
For those of you tracking institutional finance, that's a very strong number for a bank this size.
Yeah.
Shows really efficient use of shareholder capital. Plus, their expense efficiency ratio improved down to 70% for the first half. How significant is hitting that 70% mark, practically speaking?
Oh, it's quite significant. A 70% ratio means basically for every dollar of revenue, they're spending 70 cents on expenses. For a global giant like them, getting that number down, especially to 70%, shows really disciplined cost control.
Okay.
They're leveraging their scale effectively, letting more revenue drop to the bottom line. That's crucial for profits, for shareholder value.
Okay, so revenue's up, earnings beat, disciplined expenses. You'd think the stock would just soar, right?
You would think.
Well, here's that paradox we hinted at. Despite these strong numbers, the stock actually dipped initially after the release. What was the market reacting to then, beyond these great headlines?
Well, connecting it to the bigger picture, sources suggest the dip was partly down to shrinking investment banking revenue. We'll get into that nuance shortly.
Okay.
And also just broader market swings, concerns about U.S. trade policy, even reports about potential Fed changes. The market often looks beyond just the quarterly numbers.
Right. Context is key.
Exactly. But it is worth remembering the stock was still up, 14.29% year to date and over 32% in the last 12 months. So, perspective matters.
That definitely puts the dip in context. Okay, so Morgan Stanley has three main parts to its business: institutional securities, wealth management, and investment management. Let's dig into how each one did, keeping that market reaction in mind.
That's good.
Let's start with wealth management. This often tells us a lot about client sentiment, long-term trends, and the numbers here really jumped out at me. Net revenues up 14% year over year to $7.8 billion. What's the real story there? Is it just the market lifting all boats, or is there more strategy involved?
Oh, it's definitely more strategic than just market lift. This segment is clearly a huge growth engine for them. They added, get this, $59 billion in net new assets.
$59 billion, wow.
And a record $43 billion in fee-based flows. So that's not just asset values going up passively. It shows they're really succeeding in attracting clients, keeping clients, building out that platform.
And it's adding up. Total client assets across wealth and investment management hit $8.2 trillion. They're getting closer to that big $10 trillion long-term goal.
Absolutely. And the pre-tax margin in wealth management was 28.3%. That's a really strong sign of operating leverage.
Meaning
As revenues grow, their costs aren't growing as fast. So more of each new dollar flows to profit. It shows their scale and efficiency are really kicking in.
Get it.
They did mention a $22 billion headwind from tax outflows, which sounds like a lot, but they still pulled in strong net new assets overall. They specifically pointed to advisors liking the platform and lots of inflows coming from their workplace channel. That suggests really sticky relationships.
Okay, moving over to institutional securities, net revenues there were $7.6 billion, up from $7.0 billion last year. What drove that?
That was mostly strong performance in their markets businesses. Equity trading revenues soared 23%.
23%.
Yeah. And fixed income revenues climbed 9%. Seems like higher client activity, maybe a bit more market volatility, creating opportunities for their trading desks.
Makes sense.
And prime brokerage, that's serving hedge funds and other big institutions, hit record revenues and record average client balances. That's a great sign of their strength with those key clients.
But here's where it gets a little maybe counterintuitive, especially thinking about that initial stock dip we talked about. Investment banking revenues were actually down 5% overall. What's the nuance there?
Right. So that decrease was mainly lower advisory revenues from M&A. The deal market is still, a bit sluggish compared to peaks. And fixed income underwriting was also down.
Okay, so M&A is the drag.
Primarily, yeah. But, and this is the important nuance, equity underwriting revenues were actually up a lot, 42%.
42, okay.
Driven by more follow-on offerings, convertibles, and importantly, IPOs. They specifically mentioned leading deals for Chime, Hinge Health, MNTN. So, while M&A is slow, the equity capital market side is showing real life. It's a mixed picture, maybe a recovering one, in investment banking.
Interesting contrast there. Okay, finally, investment management. How did that segment fare?
Pretty well. Net revenues were $1.6 billion, up 12% year over year.
And assets.
Assets under management, AUM, had a record $1.7 trillion. And importantly, they delivered positive long-term net flows of $11 billion.
That sounds significant.
It is, especially because a year ago they had an outflow of $1.2 billion in that category. So flipping from outflow to an $11 billion inflow, that signals renewed client confidence, strong products. They highlighted their parametric platform and fixed income strategies as key drivers there.
Okay, so we've covered the strong financials, the segment performance, but the earnings call itself, it's always more than just numbers, right? It's a window into how management is thinking. What other key things came up in their discussion?
Absolutely. They definitely got into some strategic nuances. For instance, Ted Pick described the quarter as having two distinct halves.
Two halves? How so?
Well, initial market uncertainty, he said, linked to U.S. trade policy. But then increasing client engagement and a steady rebound in capital market activity in the second part. And crucially, management sounded pretty optimistic about that rebound continuing.
That sets a positive tone. And they're clearly thinking about shareholder returns, too. The board raised the quarterly dividend to $1 per share.
Yep, up 7.5 cents.
And reauthorized a big share buyback program up to $20 billion multi-year. They already bought back $1 billion in Q2.
Right. And this brings up their capital deployment flexibility. Their common equity tier 1 ratio, CET1, is 15.0%. Which is over 200 basis points, 2 percentage points above what regulators require them to hold going forward. So they have significant firepower.
For what exactly?
For organic growth, investing in the business,
right,
for opportunistic share buybacks like the one they announced, and even potentially for strategic acquisitions, what they call tuck-ins.
Tuck-in?
Yeah, think smaller deals, not huge mergers, things that fit really neatly into their existing strategy, add specific capabilities or scale. That's why they said the bar for those is super high. They had to fit perfectly, not be a distraction.
So the main focus stays on growing organically. Seems so. In investment banking, deepening client relationships, extending credit. In wealth management, broadening lending, leveraging E-Trade, that workplace channel we mentioned. And in those durable markets, businesses like prime brokerage and secured lending.
You mentioned strategic thinking.
Yeah.
On the innovation front, something that caught my ear on the call was stablecoins. What was Morgan Stanley's take there? Are they jumping in cautious?
That's a great question. It's clearly something they're thinking about strategically. Management confirmed they are actively discussing it, exploring uses for clients. They see it as part of the whole evolving tech ecosystem. But they were also cautious, saying it's a little early to tell exactly how it would play out for their specific businesses, especially compared to competitors. So watching closely, exploring, but maybe not rushing in just yet.
Okay. They also talked about net interest income, NII. What's the outlook there?
They expect it to stay pretty steady around recent levels. It's kind of a balancing act. Lower interest rates usually mean higher sweep balances. Cash clients leave sitting.
But they're also seeing strong growth in lending, especially securities-based loans. So that loan growth helps offset the potential hit to NII from lower rates on those sweep balances.
Interesting dynamic. And one more point, this broader trend of banks doing more lending through capital markets. What was the view there?
Ted Pick had a pretty striking phrase. He suggested the 15-year dam is breaking on some of the regulatory limits placed on big banks after the financial crisis.
Meaning they can do more lending now.
Potentially, yeah. He thinks they might be able to regain market share in corporate products, especially with sophisticated clients, acting more centrally as financiers, as structurers again. Maybe a return to a more traditional, prominent role in corporate finance that's been somewhat constrained. It's a big strategic shift they're watching.
So pulling it all together, this deep dive really shows Morgan Stanley delivered a truly strong quarter, driven by that integrated strategy, especially wealth and investment management. And they navigated a pretty volatile market pretty skillfully.
Yeah, the focus on organic growth, disciplined capital use, adapting to regulatory shifts that seems to position them well for, durable returns going forward. That emphasis on client relationships, integrated services, it's clearly paying off. Lets them thrive, even when parts of the market are choppy.
And we definitely saw how even with great earnings, that initial market reaction can be complex. It's driven by so much more than just the headline numbers, which really underlines why you need to do this kind of deeper, nuanced dive.
Absolutely.
So, as you think about everything we've discussed today, here's a final thought to maybe chew on. We see these major financial institutions like Morgan Stanley getting really adept at navigating, even capitalizing on, market volatility and uncertainty. Does this signal maybe a new era, an era where financial stability isn't just about calm markets, but about a firm's ability to actually thrive amidst constant change and strategically put capital to work right into those shifting landscapes? Something to consider.